Hi everyone. Good afternoon. Hi Dave. Hi Victor. Yes, welcome to today's webinar. I hope that you actually had your dinner. Today, me and Sam, which is my partner. Sam, you want to say hi? Oh, okay. Yep. So later she will be actually presenting FX, where actually today we are actually going to present FX, which is to help you to build a solid foundation in trading FX. So I want to check if everyone can hear me clearly. Please type a Y in the chat so that I know. If not, then I have to adjust myself. Okay, thank you, Dave. Thanks. Right, okay. Thank you, Jiajie. Right, okay, thank you. Now let's start. Yeah, okay. So here is actually some disclaimer before we officially start. All the content here presented are actually only for educational purposes. So if you wish to obtain any advice, please consult your TR or reminder. All right. So this is the content for today. What is FX? Mechanics of FX, quote-driven versus order-driven, and also the value added and sharing at the last part. Okay, so let's begin. What is FX? So technically, FX is actually an abbreviation of Forex and Forex exchange market. So this is the exchange of one currency for another. Let's say, for example, if you travel to US, you have to convert your Sing dollar into the local currency in USD, right? In order for you to buy food or do your shopping. So the FX market is also used to import or export product services to another country using a different currency. So let's say, for example, you buy your stuff from Taobao. So you're importing from China into Singapore, correct? So you actually need to convert your Sing dollar into renminbi in order to pay for the goods you bought online. So where do you convert it? It's actually on the FX market. Okay, so actually FX market also enables globalization, world trades, your stock market, and also online. So technically, globalization that actually allows country, where countries don't have to be self-sufficient. So let's say countries can complement each other. So for example, we actually buy our water from Malaysia or actually import the raw ingredients a lot from Malaysia, right? So that's one of the points about globalization. Right. So next, let's explore the participants of the foreign exchange market. So here we have central banks, we have all the institutional investors and funds and commercial banks and all. So first, let's start with central banks. So what do central banks do? First, they actually use to manage their currency. So let's say, for example, for Singapore dollar, if Singapore dollar actually trade beyond a certain range, MAS actually use their foreign reserve to actually buy or sell their Sing dollar so that the SGD would actually go back into the allowed range, the trading allowed range. Yeah. So for institutional investors and funds, commercial banks and brokers, they actually use it more towards hedging. So let's say, for example, Apple. Okay, so Apple have outlets all over the world, correct? And they only quote their products in Singapore in Sing dollar and not in USD. So they actually engage in the foreign exchange market so that they hedge against their FX risk. So they actually don't need to worry about their FX risk and only focus on their products, selling on their products, right? Right. So next, individuals. So individuals like you and I, we sometimes enter the FX market as speculators. Let's say, for example, okay, I think that the Singapore market economy is actually good, let's say, versus other countries. So you might actually want to trade. Let's say, for example, Euro dollar, Japan yen, if you are looking good on the Japanese economy, correct? Okay, so individuals also use FX for hedging. So let's say, for example, you actually do trading in Forex, where you actually would want to focus solely on trading and you don't want to think about the profit or loss when you convert your exchange. So let's say, for example, you are a Singapore trader and you trade on FX. You trade on a foreign exchange market, but you trade in USD. So you have to convert your Sing dollar into USD, but then you don't want to worry about the part when later on, after you trade in USD and you earn or loss in USD, correct? And when you convert back, you don't want to be worried whether the exchange rate will go up or go down at the prevailing market rate at the point where you want to change back from USD to Sing dollar, which will be explained more later. Yeah, okay, so before the next slide, I would like to ask, can anyone guess whether the foreign exchange market will be bigger than the stock market, or is the other way around? Can anyone have a guess? The FX market bigger, or is the stock market bigger? Okay. Thank you, EG. Thank you, Thye. Okay, right. Yes. So technically, Thye is correct. Where for the stock market, it's only 245 billion. But in the FX spot market alone, it's actually already 2.1 trillion. So we actually haven't included the FX futures, forwards, and options market, which is technically would be bigger than 2.1 trillion. Okay, now, so what's good about high trading volume in the FX market? Where the first point is there are actually more buyers and sellers than other markets, let's say the stock market. So what do I mean by more participants and more buyers and sellers? Which means that it's actually there are someone to always be ready to take the other side of a particular position. So a seller, let's say for example, you're a seller and you don't need to actually lower your price in order for you to be more appealing to the buyer. So next is you can actually enter large positions without moving the FX market. So what do I mean by that? So for example, when you buy, let's say 2 million of SIA in SGX and you buy 2 million of, let's say, Sing dollar USD, you actually won't really move the market if you actually buy the currency pair as compared to SIA. So let's say if you buy SIA, right, you would actually move the market where the price will actually increase a lot. But if you buy a 2 million currency pair, it actually wouldn't really move the market. It may move a bit, but not as much. So it's actually quite hard for you to manipulate the price in the FX market. Okay, so the last one would be lower frictional cost. So what I mean by lower frictional cost is, so let's say now in FX, right, there's high trading volume. So with high trading volume, which means that the spreads are normally thinner. So with the spreads they are normally thinner, you actually pay lower transaction costs when you actually buy the currency pair. Okay, so let's move on to the second section, which is the mechanics of FX. Okay, now, so this one, in Forex, currency are actually always represented by 3-letter code, which are quoted in pairs. For example, Aussie dollar and USD, and then the British pound over USD. So these are all the examples here, as you can see. Okay, now, how do we actually look at it? So always remember, the left-hand side is always the base currency. For example, here is the British pound. On the right, which is the term currency, which is the US dollar. So let's say, for example, I say I buy this currency pair. So what do I mean by that is simultaneously, I'm buying the British pound. At the same time, I'm selling the USD. So what do I mean by selling this currency pair? It's the same thing, which is the other way around, where I sell the British pound and I buy the USD. Okay, so how do I actually read this currency pair? So let's say, for example, this currency is GBP over USD 1.3. So it means that 1 British pound can be exchanged for 1.3 USD. In another way, you can say is I need 1.3 US dollar in order for me to get 1 British pound. So the next example is 1.45. It means the same way, but you need 1.45 US dollar to get 1 British pound. Okay, so based on this quotation, right, you can actually see the profit and loss will be reflected in terms of the term currency. So there will be calculations shown later. So from 1.3 to 1.45, can anyone share whether whether the British pound has appreciated or depreciated? One British pound. Whether the British pound has appreciated or depreciated based on this example, from 1.3 to 1.45. Can anyone share? Right, I have different answers. Yeah, actually, Clem is actually correct. It's actually appreciated. So because the British pound has appreciated, which means that you actually need more US dollar to actually get 1 British pound. So as you can see that you need 1.45, which is 0.15 USD dollar more to actually get your 1 GBP, British pound, sorry. So it's actually appreciated, yeah. The British pound has appreciated. Okay. Okay, now let's see. Yes, so PIP. Let me introduce to you what a PIP is, which is price interest point. So price interest point is actually a standardized unit where it actually refers to the fourth and the second decimal place movement of all currency pairs. As you can see here, the British pound over US dollar FX, it can display up to 5 decimal places, and the movement is 0.001, which is 4 decimal places. But for the special currency, which is like Japanese yen, so USD to Japanese yen, you can display up to 3 decimal places, but the movement is 0.01. Should be 2 decimal places. I think that's an error there. Okay, so 1 pip on a 100K contract is about $10, while 1 pip on a 10K contract is about USD $1. So this is the calculation that you will use later. So it actually makes the 10K contract more manageable. So for example, in a volatile market, if you take a 10K contract, it takes more pips to wipe out your account. But if you take like a 100K contract, right, you could be wiped out in seconds because 1 pip movement is quite a lot, which is like $10, 10 US dollar. Yeah. So you can also use the 10K contract to actually do hedging more accurately. Okay, so let's move on to the first one, how to calculate the FX. So this one, we need to recognize that the bid and ask. So what do you mean by bid? Bid is the price where you actually sell at. So let's say I want to sell this currency pair, I need to sell at a bid. But as for ask, you want to buy, then you have to buy at the ask price, which in this case is on our right side. So let's say I want to buy Euro USD, correct? So I have to buy at the ask, which means that you are buying Euro and selling US dollar. Whereas at the bid, you have to sell. So when you sell at the bid, right, you are technically selling Euro dollar and buying US dollar. Okay, then next, move on. Yeah, so in this part where we actually have the quantity and leverage. So what it means, so a standard lot in the FX market is normally 100K, but a mini lot, what we offer is a mini lot, which is a 10K, as you can see here on our poems. So this is technically our current price, not to say our current price, but I took it today. Yeah. So technically the Forex market trades on margin. So the leverage, so actually in Forex market, right, the majority people trades on margin where the people will have leverage, which has the effect of both amplifying your profit and losses. So as you can see here, the margin FX requirement is 5%, correct, of the contract value. So let's say this currency pair, Euro USD, you are buying one quantity, one lot, which is a mini lot. Here it's written 10K, correct? And then let's say, for example, you buy this price. So you would always need to buy at the ask price. So as you can see that this one is automatically filled up as 1.0958. Okay, so let's say, for example, if you're buying at the ask price, your total contract value would be $10,958. So the 5% of the gross contract value is what you need to put up. But here we show in Sing dollar. So it's technically approximately how much in Sing dollar that you need to put up for this contract. Okay, so it's around 739. Yeah. So with this 5% margin requirement, right? In total you have the leverage around 20 times. So which means that you can actually take on larger positions while at the same time using smaller initial deposit. Yeah. So you can also able to free up your capital for other investments. Technically, yeah. Okay, now let's do some math. So let's say, for example, if you're in a long position, you bought one lot of US dollar and Japanese yen at 1.31.25, then USD Japan yen rises. So what do I mean by USD Japan yen rises? Do you think the US dollar has appreciated or depreciated? Right. EG, would you like to try? Maybe give some time. It's similar to the previous question that I've asked just now. Right. Okay, yes, thank you so much for your answer. Yeah. So I think you got the idea there already. So yes, so which means that USD actually appreciated. So okay, once USD appreciated, I sold this currency pair. So how do I calculate my P&L? So it's the same thing that I do, which is I use this minus this and times the number of contracts I have. So it's 10,000 because it's a milli lot. Okay. So this is what I get, 1.25. And then this will be my profit in Japanese yen, 12,000. Yeah, 500. So in terms of PIF calculation will be here. So if you're interested, you can have a look. So this, let's move on to the short position. So let's say, example, Australian dollar and US dollar. I sold one lot of this. One lot is 10K on our platform. So one lot. And then Australian dollar, this currency pair rises, right? So rises. And then I exceed my position. I liquidate it. I bought one lot at this price. Then this will be the P&L. And in total, I'll be losing 120.8 because I short it and it rose, right? So technically, you are buying high, selling low. Okay. So in this part, right, can you see that the profit or loss is always being expressed in the term currency? Where, as you can see, you remember the term currency, I always say that it's always on the right-hand side. And the left side currency is what? Can anyone just type in the chat? What is the left currency? So the right currency is actually called the term currency. Yeah. Yes, thank you, Andy. Yes, thank you, Dave. Thanks, Jyoti. Okay, right. So it's base currency. So technically, both of these profit and loss is actually expressed in a term currency. Okay. Yeah. So let's move on. Okay. So now, let's introduce you to FX CFD, which is what we provide. So it provides you the flexibility to trade whenever you are free, as long as you need a laptop and internet. So technically, you can trade 24 hours a day, 5 days a week. So let's say, for example, for me, I'm working a full-time job as a doctor. So I'm quite busy. Let's say I start my work on 9 to 6. So actually, technically, you would actually want to try to actually trade something, let's say to invest your money and stuff, or to even trade. But it's actually quite hard for you to allocate time for it because you're actually working during the day, correct? And the stock market usually actually open during the day, but closes when you end work. So technically, let's say at night, you have free time, you can't really try out the things that you might be interested, right? Or there's a potential that you can earn more money from it, right? So FX CFD actually allows you to do that, where because of different FX, different market that's working 24/5. So which means that even though after your work time, you are able to actually access to all these to access the FX market basically. So if you have account with us, you can actually access it from around the world too. It's not only that you're limited to certain countries or certain markets. Okay, so for FX CFD, we have actually 39 FX pairs available online for you to trade. So we have the lowest margin requirement, which is at 5%. Not to say lowest, but a lower one as compared to a lot of brokers. And then we have the contract size of 10K, which is the mini lot. And then we do not have any commissions. We don't have any finance charge. We have no prices, no FX prices fee. Means that we don't charge for the we don't charge for the prices that you see. Okay, so we also have competitive spreads, which will be shared by Sam later on. So we also offer various platforms for you to trade the FX CFD, like Poems, and then we have Mobile P3, the MT5 platform is our new platform, and also the mobile MT5, which allows you to trade on the go in India. Okay, so let's see the rollover swap, which is the swap points adjustment. So for this, let's say, for example, if you hold a FX CFD position overnight, there will be actually a rollover of the spot FX underlying, where swap points we actually gain or lost. So this gain or loss is actually a result of the interest rate differential between currencies bought and sold. So what do I mean by that? Where the interest is actually earned on the currency bought, but paid on the currency sold. So technically, the net interest return from the underlying spot FX position will be actually credited to you, yes, as our customer, in the form of swap points adjustment. Right. So as I want to say one more time, which is we don't have FX CFD, we don't have any commission or finance charge. Okay, right. So this is the FX heat map that you can actually find it on our website under CFD.sg website. Research the tools, and then you can actually find this FX swap heat map. So the darker color, which means that the more positive or negative the swap point is. So technically, would you want a positive or negative swap points? Can someone answer? Which one do you prefer? Yes, great. Okay, yes. So I guess you know how swap point works. Okay, great. So the blue one indicates a positive one, and the red one indicates a negative swap point. So from here, you can actually see that you can actually kind of filter out which kind of currency pairs that you would like to trade, correct? So the darker color means that it's more positive. So you can actually trade the Canadian Japan yen, which is over here, or the Euro Japan yen here, because it's darker than the other, right? Yeah, so you can actually look at the different trends of different currency pairs from here. Okay, so that's all for the first and second section. And now I'll pass to my partner Sam, which will be delivering the second and third.
Okay, hi everyone. So I'm Sam. I'll be presenting on the third and fourth point. So the third point will be like quote-driven versus order-driven. So first thing first, I'm pretty sure a lot of you are familiar with the stock market. So the stock market is an order-driven. That means there's like, let's say you trade in the SGX. So the SGX will be the exchange. Then the buyers and sellers can submit their orders into the market, and SGX will have a electronic system to determine who gets filled at what price, to make sure that the buy, so long your price match, order will be executed. While as the spot FX market is more quote driven. If you realize, if you go out, when we change money in the money changer, we will see that different money changer have different quotes or bid and ask for different currency pairs. So, you can compare, and, people do compare the different bid and ask price or the quotes from each money changer, so that to determine which money changer is the best rates for them, even though the currency, the product is the same, but different money changer have different price. So in FX, usually we will have different brokers as well have different quotes or different bid and ask. So how do you determine if which, be it money changer or broker, has the best rates? Is determined by the bid-ask spread, or what we call the spread. So for Forex trading, not the money changer, for Forex trading, you need to open and close with the same broker. So let's say you open with us, or you have to close the contract with us, especially for CFD. So here, currently, these are some of the common FX that people think about, like the money changer. So here we're looking at a pair of Sing dollar, Japan yen. So if you look at the money changer, some people, they tell me, I trade FX by changing physical money. But if you see at the buy and sell, actually the spreads are really fat at 99 pips. So money changers are not really designed for you to be trading the currency pair, as you can't scale it up, because if you change more than 5,000 Singapore dollars, by MES regulation, you need to declare, and there's a lot of there's more things to do. So, the money changes for you to change, low amount of money for you to, go to another country for your holidays and so on. It's not really meant to design for investing or even trading. So next, we will have, we encourage some people use the regular FX on the P2 app. Yes, and we also have the FX CFDs that I represent. So from here, we can see that our FX CFD actually has a smaller contract size of 10,000 instead of the 100K of the regular FX. So obviously 10K, you're able to trade size a bit better, and you can of course try out more with the margin provided. You can enter and trade size better. So next, so for code driven, as I mentioned earlier, the spreads are very important, because the spreads signifies how much transactional cost you incur, because you need to open and close with the same broker. So it doesn't matter if one rate is very well, but then you have to exit, so you have to sell. When you buy, you have to sell. When you sell, you have to buy back sooner or later. Because this is trading, then you eat the bid and ask spread. So here is our spreads. So we put it out in our website. We have improved our spreads so significantly that we are highly competitive, or even way better than our competitors. So the one on the left will be our poem price tick analysis. Obviously, we have 3 sections that matters. So first one will be from as low as, then that will be the pips. So 0.3 pips. So we are doing fractional pips. So either the 5th or even 3rd decimal place, depending on which pair you're looking at. Then obviously you will tell me, hey, you say the low as this pip, maybe it just happened for a couple of minutes. So we have the average spread in pips. So that is, what you should be expecting on average. Then we also have a pip. The 3rd column will be the spread 90% of the time. So as we can see, compared to our competitors, the middle one is from competitor starting with the letter C, and the one on the right is competitor starting with letter O. So their spreads are actually, our one are way better or highly competitive. Then if some people don't take my word for it, feel free, you can load out our P2, our prices are free. So you can go and compare. Our prices are really very competitive. I have clients that I talked to yesterday that went to, I tell him, our spreads are competitive. Then he checked live. Then he tell me, oh yeah, it's better. Then, you see for yourself. This kind of thing, yeah. So next thing, so you'll realize that certain pairs have lower spreads than other pairs. So first thing first, in FX, about 80% of all FX transaction involves the US dollar. Then about 30% involves the euro dollar, euros, and 17% the Japan yen, and 13% the British pounds. So these are the more popular currency pairs. So when they are more popular, they tend to have better liquidity. So with better liquidity comes lower spreads. So if we want to create, so technically, if you have like pairs that doesn't involve the above four currency, there will be less liquidity, as you know, it's harder to find, for example, as is Singapore Thai baht. It's hard to find Singaporeans that want to buy Thai baht and Thai people to buy Singapore dollar. So how it works, how some of these pairs can be crafted is by, let's say we want to create a pair of AUD Singapore dollars. So usually how it works in FX will be, they will first turn the AUD into US dollar first. So there'll be one transaction, and then they will turn the US dollar into Sing dollar. So it goes through US dollar before reaching the final currency that you want. So because it goes to US dollar, there's higher liquidity, and that's how they're able to transact. So here's an example where we can see that the AUD USD will convert AUD USD at 1 USD 1.49689 AUD to 1 USD. Then proceed to turn the USD into Sing, and that's how we can derive the rates of AUD USD, AUD SGD. So yeah, so if you have like some pairs that are more exotic in nature, especially not the main highly traded currencies, you may incur higher spreads. Yeah. So this it's not because we want to earn more money off you, but this is how it works in the FX market. So lastly, we'll talk about some value adding either to your investment portfolio and so on. So how does FX affect everyone? So as you know, as we mentioned earlier, everyone is exposed to FX risk. Whether you are directly affected, be it you go other countries very often, you purchase things or are overseas very often, or indirectly. Let's say you only stay in Singapore, you only buy goods in Singapore. But a lot of goods in Singapore are imported from overseas. We import a lot of our food, a lot of our essential supplies from overseas. So you are indirectly or directly affected by FX. Then big companies hedge their FX risk, especially the big companies that we mentioned, like Singapore Airlines, Apple, and so on. Because they are multinational companies, they sell goods all over the world. They need to manage their FX risk because their business is to sell iPhones or provide services. Their business is not to manage, not to speculate in FX. Yes. Then for investors like you and me, when we usually, it's quite popular now to buy foreign shares, be it in Hong Kong or in US. So US shares have been quite popular. So when you buy US shares, you need to pay US dollars. They're not going to accept Sing dollars when you buy Apple shares. So we'll need to do a FX transfer, FX foreign exchange transaction. But however, some people, they still a bit don't believe in it. So they tell me there's no point in hedging FX exposure. Like how bad can it be? So, okay, so here is a very easy example. So let's say you are a very good investor or trader. Let's say you're a very good trader. Okay, you decide to buy 1,000 shares of Amazon. So you need to at $95. So you need 95,000 US dollars. So obviously you're saying you transfer at the rate in November is about 1.42 Sing for 1 US dollar. Then you need to transfer 134,900 Sing for this buy transaction. Then a few months down the road in February, you sell your Amazon share at $102. So you made a $7 US dollar gain. So you are doing great, while you make money, you're happy. But when you change your US dollar back into Sing, you realize actually you're only able to change at the rate of $1 only change for 1.31 Sing. Actually, at the end, when you change back to Sing, you actually lost money of $1,280. So even though you did great in trading and earning US dollars, but as you know, you exchange it back to Sing, you actually lost money. So this shows how severe FX risk can be. Obviously, this is just an example. It could go, even worse or not so bad. But these are some of the risks, potential risks that you can be facing by just buying foreign shares. Don't worry, FX CFD can be your answer to your hedging needs. So what this person could have done is he could have sold 10 mini lots of US dollar, Sing dollar. So is this shorting the US dollar and shorting US dollar so that when the US dollar, if it happens to go down in price, he will not lose out on the FX rate because he has already effectively hedged his FX risk. But it also means that the US dollar appreciates. Obviously, his FX CFD position will drop, but his stock side, when he sell his 1,000 Amazon share, he's able to convert it back to more Sing dollars. So, so this will focus on, hedge out all the FX risk and focus more on your trading. So if you're able to make money in trading, your FX risk is taken care of, you're able to generate profit. So as a trader, sometimes we only want, there's a lot of variability, a lot of variability in our profits, be it, whether we can enter and exit at a good price. And now that there's a new FX risk, sometimes it's wise to hedge off the FX risk and just focus on our trading. So FX CFD is able to do this. Be it you are trading or you are investing, locking in your FX risk or hedging off your FX risk is quite beneficial, especially when you don't want to guess which side of the coin is it going. Is the FX, the pair you are looking at going to go up or go down? After you hedge it off, you don't have to worry about it. And the cost of hedging, as there's no commissions, is zero, but the swap rollover points or the swap points, for this pair US dollar Sing is actually very minimal at negative 0.005 for 3 months. So next, some of the people will come to me and say, Sam, I know I should do this, but I scared because leverage. Leverage means you borrow money. Everything is you amplify your gains and your losses. It's very risky. But leverage should be seen as an advantage. Why? Because leverage allows you to able to open contract size much bigger. One, much bigger. Number two is you're able to utilize your assets a lot better. So you can able to make better use of your capital, and also you can able to trade size a lot better, and so you can position size everything better, easier. So leverage with proper management, then is not equals to risk, because you need to have a proper risk management. You need to understand your strategy and know how to manage your leverage and positions. It's just like, if you give a sports car to a person who just learned driving, he's unable to utilize the sports car fully. But if you give it to a professional who understands how the car runs and able to push it to its limits, able to utilize it the best. So to me, leverage is an advantage to traders. You can able to do a lot more with it, with what you have, given the proper risk management. Okay, so now that I talked about FX CFD, I'd like to share with you our new platform, which we just released in March, which is our Poem CFD MT5. So if you are not familiar with MT5, MT5 stands for MetaTrader 5. So MetaTrader 5 is a multi-asset platform, which currently we offer CFDs on it, from index to FX, which is both of our most popular products, to the US stock market, to Singapore stock market, and DMA as well. And we also have commodities. So MT5 is quite popular among traders. It has been around for quite a while, as in, it's been tested and proven that, the system works, and it has a lot of advantages that a trader will want. Such as, for MT5, we have the one-click trading, which is also known as the chart trading. So, with a click of a button, you can enter in and out of positions. We have a lot more advanced order types, from good to close orders to entering into positions with take profit and stop loss at the same time. So this is something that a lot of traders have been asking us for it. And also the hedge mode. So hedge mode, you are able to enter in the long and short position at the same time, which our opponents' system currently is unable to cater to. But then, however, we need to take note that there is a auto closeout function. So, if your margin, if your equity drops below 50% required margin, the auto cut function will kick in just to prevent you from hitting the overloss. Is to protect you from potentially overloss in your account. Yep. Then, of course, we have more, such as for exclusively for MT5. If you trade with us, if you hit a certain trading volume of FX, we have this trade reward for different products, all the products, but I'm here just to highlight the FX first. So as FX, there's no commissions, no finance charge, only swap points if you hold overnight. So if you're able to trade 10 million, you may feel that 10 million is a lot, but as contract size are minimum 10K, and you can trade with low spreads and zero commission, hitting 10 million is very achievable. Then once you hit 10 million, you're able to get rebates, trading credit rebates. So for a product that has no commissions, you can still get rebates. 20 cents per 100,000 in value, traded volume value. So obviously, the more you trade, the more you get. So MT5 really is the platform for traders who wants to enter in and exit out of positions, intraday trade, even swing trade, as you can take advantage of this trade for reward program. That is only for MT5. So you trade on Poems, sadly, there's no trade for reward program. So lastly, we would like to shout out our promotion. So because this is still in June, this promotion is still live. So if you can create a MT5 account, here's the reward tier. So you create an MT5 account and you do an initial funding of $1,500. Initial funding, I remember. So your first funding of $1,500, and you do five buy or sell trade up until end of June. So you only got a few days left. But this is quite easy to do, You just deposit, do 5 trades. You can do on FX as well. FX, any trades. Then as there are a lot of them, there are commission fee, even our index are no commissions. Those ways you achieve, you get $50 CFD trading credits. These trading credits, you can withdraw it out as well. So it's like money. Then next will be if you deposit $5,000 and you proceed to trade 10 times. So one buy and one sell is considered 2 trades. So it's quite easy to achieve. You get $250 trading credits plus another $50 Grab gift voucher. Then lastly, if you have a lot, if you can, I'll go for this. It's the initial dollar of 30,000 and proceed to buy and sell, have 50 trades. Of course, one more thing to take note that there's a lock-in period of 90 days. So even though you complete this, but you must complete this in June, so you only got a few days left. But you need to lock it in for 90 days, your initial deposit. So after you trade, you can leave it there, and don't worry, you'll be entitled to the rewards. So you do scan our QR code if you want to know more about this. Yep, and if you're still hesitating, you don't know whether FX is the product for you, or even MT5 is the platform for you, don't worry, we have a MT5 demo account you can create easily. You can scan the QR code, then click on the try demo button, then just follow instructions. You'll get the free demo account, which you can try, use our system, see whether you can even back test some of your algorithmic trading strategies and so on, and see whether MT5 is for you or even FX is for you. Everything is all free, there's no charges or anything, and you're able to try out, see whether you enjoy it, see whether your decisions are right, and if you are comfortable, you can proceed to start trading with us on a live account in MT5. So now will be the Q&A section. So don't worry, we may get some questions, then feel free to email us. And in any of the 3 emails, the second one will be my email, then Onisha's email, and also our CFD email. So just in case we cannot get to you, you can always approach our CFD email with any queries about CFD, be it MT5, FX, or any of our other products. So let's see if you have any questions. Okay, I have a question from a anonymous attendee. So what is your view on US dollar in the short term? Okay, so, by right, I'm not supposed to say, what I think, but, so I'll just give you a more fundamental way of looking at it. So the Fed currently, now US dollar mainly depend on the Fed's rate hike cycle, whether how much analysts and market participants are expecting the July rate hike, because they paused in June. So July, people are speculating whether it's 25 or 50, and also what they're going to do in the upcoming months after that. So in the short run, if we observe the US dollar Japan yen pair, you realize that the Japan yen has gone down a lot. So most likely markets are expecting the Fed to be a little bit more aggressive on the rate hike, and the high rates are expected for longer. So yeah. So pay more closer attention to some of the macro data coming out of the US. So especially if there's any signals that inflation is still high, then the Feds are more likely to lean towards maintaining a high interest rate, which will result in a stronger US dollar. Yeah. Yeah, in the FX market, especially recently, the yen has dropped quite a bit, resulting in a lot of their stock market actually appreciating quite a lot. The Nikkei has been going up like a rocket. Okay, next question. Does US dollar usually go in opposite direction of US stock market? Not really. But other commodities like oil and such that are priced in US dollars, on the other hand, usually goes in the opposite direction. So the strong US dollar, usually the commodities like get affected in price from gold to oil and so on, because usually they are priced in US dollars. But because US dollar has been so widely used, be it from trading to all the central banks holding US dollar as a reserve currency, US dollar has a different sort of immunity to all this. Yep. Then if you are trading FX or investing in the stock market in general, do check out our weekly update that we have. We post every week on the Poems website under the education and market journal section. We have a market update, updates for the week, where we'll update not just we don't just have a recap on the previous week's action, but also what's upcoming, especially the macro side, and also the macro as in, what kind of news release are coming out. And we also have a commentary where we write a short paragraph, just to describe what are the markets expecting, what the analysts sort of looking out for. And we also have a corporate earnings section where we're trying to highlight companies, especially the big cap companies that we are investors are most likely to hold, that have upcoming earnings. And of course, earnings generally tend to affect a lot of move the price, especially if the stock is more speculative in nature. So we will cover all that in our weekly update that we post every Monday about between 8 to 9 a.m. Then do check it out. We will see whether my colleague can post the link into the chat. That'd be great. So you all can check it out when you're free, and do know that we update it on a weekly basis. So okay, any other questions? Don't feel free. I mean, if you're shy, you can always email us. We can answer through the email or even call in to our dealing